Greetings and salutations, Real Estate Undergrounders. It is Ed Matthews with the Real Estate Underground. Thank you again so much for listening to the show. If you enjoy this show or any of the other episodes that you happen to listen to, if you could share them with a friend, subscribe, and also leave us a comment. I'm always interested in learning about the types of topics that you folks all want to learn about. And so with that, I am joined by Zack Gray from Freedom Management. Zack, welcome to the show.
What's up, guys? Thank you so much for having me on today. As Ed had mentioned, my name is Zack Gray. I'm a local real estate investor here in Greater Worcester County, which is located in Massachusetts, for those of you who may be a little bit unfamiliar. Hopefully, I can share some insights to just my personal journey and as well as my investing journey. And I hope that there are some takeaways that can be utilized for your own self-benefit for all the fellow investors that are here listening today.
Excellent. Thank you. For those folks out there who aren't familiar with you or your company, why don't we talk about what Freedom Management's all about and where you focus?
Yeah, absolutely. Basically, Freedom Management is made up of myself and my immediate business partner. His name is Andrew Freed. The two of us co-founded it. We currently have about 8 or 9 people who are working for us. We basically invest in predominantly buy and hold value add multifamily property in a couple different demographics. Most of our units are contained within Rhode Island, Massachusetts, and then we have a small subsector in a suburb market outside of Charlotte, North Carolina.
Okay.
One of our close contacts just happens to live there, and he's an operator of the deal that we have there. But we specialize in Massachusetts and Rhode Island. In addition to that, we've been in business for roughly about 3 years. We have gone from 0 units to 240 units in that time frame. If you count my partner's units as well, I only counted my own. He has some independent units on his own as well. It's roughly about, let's call it 270.
Wow.
We've been able to amass a pretty decent amount of success in a short period of time. I attest that predominantly to relentless pursuit of continuing education through listening to podcasts, attending my local meetups. I probably attend about 5 meetups per month. I try to guest speak. My goal is to guest speak at least 6 meetups this year, which I have already done, which is great. And I think that I used to be a little bit more passionate about audiobooks and pursuing books as an avenue of knowledge accumulation. I think that we've just been so busy in the front half of this calendar year that's fallen off a little bit. But yeah, that gives some general insight to our operation and what we do and that kind of stuff.
Okay. All right, cool. You are in some markets directly adjacent to where I am here in Connecticut, and also Charlotte, North Carolina is a market that we're actually targeting right now. So tell me about your buy box here in New England. What does it look like?
In New England, the way that we structure what we are looking for on properties that we're looking to purchase we're looking for anything from 2 units up to, let's say, 50 units. It could be either a single standing building or it could be a portfolio. In regards to how we track whether we are interested or not, is we are habitually looking for properties in which the all-in cost, so that includes purchase price and renovation associated, to get the units up to performing. We take that quantity and we'd like to see pro forma rents equating to 1.2 to 1.5% of the all-in cost.
Okay.
That is the metric that we use, and that habitually yields the type of financial performance that we are searching for in our acquisition. Now, I'm going to strip that down a little bit. And basically what I'm going to say is, to be a little bit more digestible, the way that we calculate pro forma rents is we actually use a website called FMR, Fair Market Rent, and it's done through the HUD organization.
Yeah, sure.
So we are making our assumptions subjective rather than biased. We are not making assumptions on what we can rent units for. We are using the parameters that are provided by the government as to what they will pay for each unit size in that demographic via assistance programs such as Section 8. So then we know, worst case scenario, we could rent our units to Section 8 to achieve the underwriting that we have put forth. Banks love to see this because now we are not bringing information to them saying, we believe we can rent these units for this price. We are saying, we know that we can rent these units for this price based off what the government tells us. And making it subjective rather than biased is huge for underwriters at the banks. Getting back to how we calculate what we're looking for and how we are looking, what we're looking to buy. Again, 2 to 50 units. We take whatever the purchase price is. We calculate our renovation budget. So let's say it's $1 million. Let's say that our renovation budget is roughly around 200,000. We're all in for 1.2. We would be looking for the rent roll to be roughly around 1.5% of that. 1% of 1.2 million would be 12,000. So 1.5% would be 18,000. So we'd be looking for a purchase price of 1.2 million to yield 18,000 in a month in rent roll as the pro forma. That's the upper limit, right? We'd probably be closer to 14 or so, 14,000, 14 or 15,000 in gross, but somewhere in that vicinity. And that's habitually how we try to underwrite that. And in regards to targeting cash on cash returns and how much forced equity we will generate from the deal, we're targeting being able to generate up between a 9 and a 15% cash on cash return on our deals. And we're looking to be able to refinance between 50 and 100%, 50 to 100% of investor capital out in the first year and a half of ownership.
That's aggressive. Even in this market. So let's talk about interest rates and how that's affected your business model. Curious about, obviously you've been doing this in a very interesting time, right? The last 3 years, 3 years ago, the interest rates were in the 4s and 5s. And then all of a sudden, bam, 11 interest rate increases. And here we are in the 7s and 8s. How has that affected your ability to execute and operate?
Yeah. So I think there's a couple intangibles that are important to know. I think that one of the things that allows for us to execute on the business model is all of our projects that we pursue commercial lending versus traditional lending. And we pursue commercial lending in particular that provides renovation-based funding. And the reason that we do this is because when you pursue commercial-based lending with renovation funding coming from the bank, what this allows for is it allows for you to use pro forma rent roll when calculating debt service coverage ratio for the lender. Why this is advantageous is that you're buying an underperforming asset that has a very low rent roll on day one.
Right.
The bank looks at the existing rent roll and says, based off the revenue stream that exists right now, right, you're going to have to bring a lot more money to the table in order for us to meet our debt service coverage ratio parameter. But we'll lend you a lot more money for you guys to be able to go in there, knock down walls, put up new walls, flip units upside down and renovate them up to A quality, do CapEx projects. And based off your experience, we trust your analysis. So now we'll use the pro forma, which allows for you to bring a lot less capital to the table. So normally in our deals, we're bringing 20 to 25% down. With that being said, all the money that we would normally need to fund all the renovation of the building, we're getting between 75% of renovation to 100% of renovation funded by our banks. So now we don't have to raise that capital from investors. And why that is advantageous is last I've checked, I've never had to give equity to the bank for them loaning me more money.
True statement.
Right? So I don't want to raise capital from investors to do renovation because I don't want to have to give up. I don't want to pay preferred returns to them. And I also don't want to give equity that I don't have to forfeit. With that being said, coming back to the original question of how are you guys able to execute that business plan in the current environment? And the answer is when you have to bring 20 to 25% down, but you're not funding the reno, you're not having to front that massive quantity of capital, you have less capital in the deal. And when you have less capital in the deal, that juices your cash on cash returns, and it amplifies your ability to then refinance proceeds out to our investors. The second component that allows for us to reach these thresholds is that when we refinance a deal upon reaching stabilization, 100% of our refinance proceeds go to making our investor whole. We as operators do not split the refinance proceeds relative to LP or GP stake. So what I mean by that is, let's say the deal is 70-30. The refinance proceeds should have to be 70-30. We are not doing that. If it's 60-40 or 50-50, we are not splitting the refinance proceeds 60-40 or 50-50. We are giving 100% of the proceeds back to our investors.
Okay.
This enhances the velocity of their money because now they are able to get more of their money back more quickly and then recycle it into future deals. Now, for us, we look at it one of two ways. First off, as we are service providers, we are the operators and we are service providers to our investors.
Mm-hmm.
Our main prerogative is to be able to provide an excellent service to our investors, enhancing their return structure relative to other competitive operators to entice them to continue to want to invest with us. And ultimately, the more deals that we do, the more equity we as operators make.
Right.
Now, we might not have access to those funds because we're not gaining access to those funds via refinance. But presumably, if you're taking care of your investor basis and you're expediting the return of capital to your investors, you are going to have investors that not only are reinvesting into all your future deals, they're also bringing people with them because you are taking a selfless approach to how you run your operation. And ultimately that is going to pay huge dividends into your ability to scale more rapidly, which is exactly what we have done.
Okay. So I love the approach. Now, how do you make money in that scenario? Are you charging fees, asset fees, acquisition fees, things like that? Or
Sure. So I'll back up and explain how we make money.
So let me just interrupt 1 second. So for those of you out there who are talking or listening, what we're talking about here is syndication, correct? Yes?
So yes, syndication or joint venture structure.
Okay, good.
What we do is any deal in which we are raising under $1 million, we habitually do a joint venture structure. We habitually have the ability to pool between 1 and 6 or 7 investors to come up with $1 million or less.
Okay.
Anything that's over $1 million, we know that we're going to end up having more than 7 investors. So then we tend to target a syndication model with that type of option. That's just parameters that we use. I'm happy to dive more and answer questions on that later on. But getting back to your point of like, how do we as operators run our operation and make money? So what we do is we find a deal, we offer on the deal, and we receive an accepted offer. Once we receive an accepted offer, we go back to to the seller, and we say, hey, we want to bake in a closing cost credit to reduce our out-of-pocket costs because we want as little capital in the deal as possible to juice our cash-on-cash returns.
Right.
And then we also bake in basically a 2% increase in the purchase price to account for a 2% transaction fee for us. So now what we're doing is we're baking that in on top. So it's coming from we're basically financing it. Do you follow? We're financing it as part of the loan rather than taking the money from investor capital.
Got it.
We're not taking money directly. We're taking money in the form of the loan and then front loading that fee to us. We use that acquisition fee, that buyer's agent fee, to go into our, let's call it PM company or our management company.
Right.
These funds are used to deploy earnest money during acquisitions, due diligence costs, and to pay for our day-to-day operation, whether that is PM assistant, admin assistant, executive assistant, VAs, maintenance techs, things like that.
Right.
So that's how we fund our operation. Now, in regards to deal structure, what we do is there's two things that are different between our operation and a lot of other peers. One is that we do more joint ventures than we do syndications. And in our joint ventures, we actually personally guarantee the preferred return. So we personally guarantee the preferred return, and we charge an 8% property management fee. So in the event that our preferred return is compromised in some way, we can pull from the PM fee to make the investor whole on the preferred return. So now what we've done is we've established a floor for our investors. Again, service industry, providing the best service, enticing them to understand that this is the best product or option for them. Now, in return, what we are asking for is we are asking for the split to be a 50-50 split. We ask for a 50-50 split of equity in the deal. So now what ends up happening is they get the first 8% of the cash on cash returns. Anything north of 8% is split 50-50. Then we are 50-50 owners of all upside of the property. So we are hyper incentivized to get the deal to perform because we have to pay the pref return regardless. And in regards to the upside, we get 50% of all the upside of the property. So that's where we make money. Now, the standard split is 70-30 for most syndication models or JV models. So we are actually getting an additional 20% equity from the standard model. But what we're doing is we're personally guaranteeing the pref. And then the second component that I had mentioned that's different is that we are providing 100% of the proceeds from the refinance back to our investor basis. And so that increases their velocity. So our money is left sunk in the deal. Now, what I want to point out in this is that why we pursue this model is because it expedites the investors getting 100% of their capital out.
Right.
Once the investor capital is out, if you and your investors are 50-50 partners, you now as an operator and as an investor now have the same stake in the deal. So you are both going to mutually be incentivized to want to hold or want to sell. Sure. There's no discrepancy because you're both receiving the same material benefit.
Right.
Why we do this is that we want to constantly be in lockstep with our investors as to wanting to hold or wanting to sell. And our model as investors is we want to collect as many revenue streams as possible in as short a time as possible. And we want to own 50% of those revenue streams rather than 30% of those revenue streams. And if we provide capital back to our investors more quickly, then we're going to be able to collect more streams. And if you're getting 50% of every pie, you're ultimately growing your net worth at a much more rapid pace, which is ultimately the goal for you. I think that people who target the 70-30 model are a little bit more short-sighted. I think the people who don't refinance all the capital back to their investors, it's a little bit more short-sighted. I think that ultimately what ends up happening here is last thing is, in all of these deals, 100% of the capital that is in the deal comes from our investors. So we do not have any of our own capital in the deals post-close. So I'm getting 50% of every single transaction that I'm doing, and I have no capital.
It's a good deal for everybody.
Stay with us. We'll be right back.
A motivated seller just filled out your web form. If you call back within 5 minutes, you're nearly 4 times more likely to get that seller appointment. But delay your follow-up by even just 10 minutes? Forget it. You're toast. Ella Vista Connect calls that lead back in 60 seconds, qualifies them, and schedules your meeting. Find out how much slow follow-up is costing you. Free calculator at ellavista.com/underground.
I like the way that you align your objectives with your investors' objectives. It's an interesting approach. It reminds me of Joel Greenberg, who's a gentleman in the Midwest. He's in the Chicago area, and he does something very similar. Actually, he goes one step further. Doesn't even deal with the banks, just simply raises the capital himself to acquire and with a group of investors. And then ultimately properties acquired and stabilized, that's when we refinance out and all of that money goes back to the investors. And I think, I don't remember the percentage of the deals that he takes, but it's a similar approach. I see that it certainly reduces a lot of risk for your investors, which is really clever. And increases your risk a little bit, but you have the ability to operate what you're capable of, and your management fee protects your downside. So
what I would say is that if you're personally guaranteeing the note with the bank, at that point, what difference does it make?
Right.
You're personally guaranteeing the note, whether you're personally guaranteeing the note, personally guaranteeing the pref, you're on the hook for the whole enchilada.
Right.
So you're materially responsible for how things go.
Right.
And I think that what this comes down to is that what we did is we executed deals on our own behalf with proficiency before bringing in investors.
Right.
So there's two sectors of our business. There are deals that we have as operators between myself and my partner.
Sure.
With no investors. Those deals are happening and we are recycling our own capital.
Right.
Then what happens is, out of the deals that we get, there's either deals that are too large for us to take down by ourselves, or out of the deals that we get, the most advantageous deals are going to go to me and my partner.
Mm-hmm.
So we're going to cherry pick the best deals. And then the ones that everything that's left, these are all great deals, like deals that are generating 9 to 15% cash on cash with refinancing 50+% of your money per year. I think any investor in the country would take those. But my point is that what you're allowed to do now is you now have a whole bunch of deals going down over here, and you have your own deals that are spiraling over here. So so what I also say is myself and my partner, we do not live lavish lifestyles. He drives a Camry. I drive a pickup truck. I live in the sticks. He lives like a college kid with roommates. We are not balling out, going out on the town, throwing money around. That's not what's happening. We're not going on lavish vacations. We are grinding 80 hours a week and just making shit happen, for lack of a better term. But what I'm getting at in all of this is that having our own deals that provide enough cash flow for us to get by, right? And then for us to live our own lives, and then recycling our own capital to like very sequentially grow what we are taking in for ourselves. And then executing this whole other sector with all of our investors. It's like building a retirement account, but it's a retirement account on steroids, right?
Right. Indeed. Yeah, no, it's very smart. Yeah. I like the way you've managed your risk. I'm just curious, when in the market, so I own just on the other side of Worcester County, on the Connecticut side of that border.
Are you talking like Putnam, Killingly, Norwood?
Jewett City, Willington, Stafford Springs, Wyndham, Willimantic, in that area.
Yes.
And so I'm curious, and some of those towns tend to trend towards Worcester, the Worcester MSA versus the New London, Norwich MSA. So for those that don't know the area, those are counties in Connecticut and in Massachusetts. So I'm curious about the deal size relative to per unit. on your side of the border, which I know tends to be a little more expensive, but there's reasons for that because Massachusetts tends to be a more vibrant economy, jobs economy. Obviously, the buildings cost more, the rent costs more, and so on. So I'm curious, here in Connecticut, they range anywhere from, call it $80,000 to $100,000 for a C-class building. So I'm curious about where the price points in your part of the world.
Anything that's on the periphery of Worcester, north, west, or south,
Yep,
can range from 100 to like 130K per unit.
Okay.
Worcester itself, we buy between 125 to 55K a unit, but units sell for about 180 to 200K a unit.
Rehabbed.
Yeah, like retail. And what I will say is that like, then we own some stuff in slightly east of Worcester, in which you'll see stuff float between 200 and 300K a unit.
C-class buildings, or is
That's
B minus B building?
That's like B class. So what I would say is like anything that's 100 to 130 is probably like C class. Worcester used to be C class, and I think that it's now like C plus B minus. And I think that everything east of Worcester is like B class.
Yeah, makes sense. Okay. All right. I'll tell you, man, your business model is absolutely fascinating. Congratulations on all your success. So where does this, you're a young man, so where does this end? What's the ultimate goal?
Our goal is 1,000 units in 5 years. So we're at 240 right now, 240 to 270 between the two of us. So we're trying to 5X in the next 5 years. And what I would say is, just for example, like we had 120 units at the beginning of the year and we're at 240 and we're 6 months in. So we've had a very aggressive start to the year, and we're starting to see holes in our operation and our efficiencies. It's like try to build the boat while you're sailing. So that's been a lot of fun, and it continues to be a lot of fun. But I think that ultimately, like, we have a great foundation in regards to our team. And I think that one of the things that is unique to our operation is that as soon as we deem somebody to be proficient in their role and indispensable, we then basically make note of this to them. And then we basically provide them some attachment or equity stake to deals that they are materially operating on. And so
when you say equity, are you talking about actual equity or profit sharing?
Actual equity. They are on the operating agreement.
Okay.
And what I will say is that's a testament to how me and Andrew operate. If you're going to, like, we have an 18-year-old kid who was our first hire, who is basically is like our PM. At this point, he is so indispensable. If I could clone him 5 times over, I would. And he's now 19 years old. In this year, he's just gotten equity staked on 2 of his first deals. And so moving forward, he has the capacity to probably be able to get equity staked on 5 or 6 deals per year. And each deal, he's might be getting 20, 30, 40 grand in equity. But you're talking about somebody who might be able to accrue between 120 and 140K in equity per year starting next year. In addition to his earnings,
right?
We paid for him to get his license. So now he has his license. So now he can sell real estate too. And you're making a salary. You now have an ability to execute selling and buying, representing people to sell and buy. And you're getting 120 to 140K in equity and property. And that's only going to continue to grow as we continue to grow. You take a person like that who's 19 years old, that's life-changing for that person. And this kid is not, and that kid's not even, that kid didn't go to college, right? So you're changing somebody's life, but that person, I literally depend on that person every single day of my life.
Right.
So this is where it's, hey man, like I need you, you need me, but we're going to make sure this works for everybody.
Right.
So I think the biggest thing is like people who want to work for us, we take care of them in a very meaningful way. And also, this is probably a great time to mention that we are hired.
Well, that's great. Zach, I've enjoyed learning about your business, man. You're a wealth of knowledge, and congratulations. Let's move on to the final four.
Yeah.
Let's get into your mindset and what makes you tick specifically. First question of the final four is finish the sentence. My purpose is.
My purpose. I think my purpose is to fulfill the people I care about while pursuing self-fulfillment.
Good answer. All right. Second question. So invariably, guys like you and me, we are blessed by mentors and sometimes coaches who have come into our lives and have thrown an arm around us, either because they see something in us, or sometimes they take pity on us and they help you understand, here are the things that are going well in your life, and here are the things that you're messing up, and here's how to fix them. And those people are absolutely invaluable, the truth tellers in your life. So I'm just curious, what is the best advice you ever got, and who gave it to you?
I'm going to use a quote, and what I will say is that it's not one individual. It's a culmination of impactful individuals throughout my life, but it's essentially hard work beats talent every time. And what I will say is that I have a multitude of people that have helped frame this and shape this, but I think it starts all the way from the ground. My dad, who was a sole provider for my family and was putting in 70 hours a week, working 6 days a week when I was a kid, up to some pretty impactful coaches that I had in my youth in sports, John O'Reilly, Chris Boy, name it too. And I think then it trickles down to people like my experience in the military and people, drill instructors, and people that I went through training, and you're putting in 14, 16-hour days, 7 days a week. And you're doing it in inclement weather, and you're doing it in suboptimal conditions. And I think that when you have the ability to wake up with an air-conditioned house on a hot day like today, or you have a nice warm bed to sleep in at night, I think, putting in 6 or 7 days a week to pursue something you're passionate about, you're the luckiest man on the planet, man. I look at that, and I think that we were born into probably you were born into the most opportunistic, best country on this planet. If I was born in the middle of the sand in the desert out in the Middle East, I wouldn't be doing what I'm doing right now. So I look at it every day and say, I'm blessed to be doing what I'm doing. I owe it to the opportunity that I have to attack my life. And the last people is, I think the biggest one is, as adults, if you go around and ask any single adult who their role model is, most people don't have an answer. And I think that's crazy. That is so crazy to me. And what I will say is, I have people who were clients of mine that were extremely professionally successful well before I was, when I was 25, 26, 27 years old. And some of those people, John Tower, Sam Ross, Dave Hatch, people that I know on an intricate level, that have completely shaped who I am as an individual today. So I don't think it's one person, but every one of those people that I named, they embody exactly what I am, which is hard work beats talent.
Every time. So I'm also curious if leaders like yourself tend to be readers. And so I'm curious how you sharpen the saw, so to speak. And I'm also always interested in the authors and creators that you're paying attention to. So how do you take in information, and who are you paying attention to these days?
Yeah, I definitely am a big podcast person. I listen to bigger podcasts. I listen to On the Market. I listen to Real Estate Rookie. I listen to a couple podcasts that are relative to like tax code. I could send you the names of those if you're interested.
Yeah, put them in the show notes. I'd love to.
But those are, I think I am definitely a frequent podcast consumer. I also, in regards to books that have been super impactful for me or that have changed the game for me, Extreme Ownership by Jocko Willink, Checklist Manifesto, don't know the name of the author. Go Giver is another huge book that has been super impactful for me. And then other ones are Limitless. I think that's the Jim Quick one. And the last one that I would label is Brain Audit. I don't remember the name of the author for that one. Those are 5 books that jump out to me as, man, that was super impactful for me. And then a little bit less kind of self-improvement, a little bit more. I like self-improvement books and I like podcasts that are really informative. I'm also really big into philosophy. And I think that I tend to like books that are a little bit more philosophical, stuff like The Alchemist, stuff like The Richest Man in Babylon. They're more storytelling and they're more philosophical about like how you view life and how you pursue your strategy in terms of self-fulfillment. I like stuff like that. That's probably a fair list for people to get started.
It's an excellent list, actually. Yeah, congrats. And actually, there's a couple on there that I just learned about. So we'll make sure that all of these are in the show notes. So
Absolutely.
Advantage of learning from those books.
What I will say is that for somebody who is a solopreneur, who is looking to go from solopreneur to full-fledged leader, operator, running a business, Go Giver is the number one book that you must read in order to go from building your own success to then building a team that wants to achieve more with you.
Right. And get aligned behind a common goal, right?
Exactly.
Yeah, it was one of my favorite books. Okay, last of the final four. I want you to finish this sentence for me. Success means
Freedom.
all right.
Success means
Zack, I have really enjoyed this conversation. You are an impressive man and you've got one heck of a company. And I thank you for your time today. So I'm just curious, when you're not talking about real estate or chasing down deals or managing assets, what do you like to do for fun? Even though you work 7 days a week, 16 hours.
No, I really like to lift weights. I'm like an amateur, non-competitive, but like sort of power lifter, I would say. My wife and I just bought a house out in the sticks, right on the Connecticut border, actually in Southbridge area.
Nice.
And we plant a lot of flowers. We have a huge garden. We have a couple acres of land. I'm a pretty avid Boston sports fan.
Good.
I like to go to games.
Good answer.
I'm obsessed with live music. I would say on the weekends, you're probably going to catch me going to see live music somewhere.
Yeah. Awesome. We're recording this, a couple of days after the Celtics won their 18th Go Seas.
I was at game one, baby.
Oh, that's awesome. Congrats. Yeah. All right. So if somebody wants to learn more about you or Freedom Management or your partner, Andrew, what's the best way to get in touch?
Yeah. So Andrew is at Investor Freed on Instagram. Mine is at the 1099 Mindset on Instagram. On my Instagram, my link in the bio is for our mailing list. You can receive how we structure our deals down to investor tips, to all the deals that we are currently doing, all the deals that we offered on. We give monthly updates on every single project that we have in process. It could be helpful for ongoing investors who are looking to scale their operation, but it can also be helpful for people who are potentially interested in investing in deals with us. So again, I would say reach out to me on social. You can friend me on Facebook as well. Zack Gray, Zack with a K, Zack, and follow me on Instagram at the 1099 Mindset. Join our mailing list and then let's connect. All
right. Sounds good. So Zack Gray from Freedom Management, thank you again. And also thank you for your service to our country. Grateful for that. And so that's it for today.
Thanks so much.
This has been the Real Estate Underground. Don't forget to subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.